thank you very much for joining our Q4 Manufacturing Outlook webinar today. I'm Richard Austin, even though you can't see me, and I'm BDO's National Head of Manufacturing. I think it's fair to say that 2022 in the round has been a rather interesting year for the economy and also for the UK manufacturing sector. And according to our latest Make UK and BDO Manufacturing Outlook survey, the sector has had a sobering end to what has been a very mixed year, and we'll pick up on that shortly. Just in terms of the people who'll be joining to present today, we're delighted to be joined by Make UK's Chief Economist, Seamus Nevin, who will be providing a high-level manufacturing and economic update based on the results of our Q4 Manufacturing Outlook report, which was published yesterday. Following that, we'll be running a panel session to discuss some of the key challenges that the UK manufacturing industry will be facing and has faced over the last few months. And that will cover off areas such as energy prices, which is a big issue for a lot of the clients that we're talking to at the moment, business rates as well, and also interest rates. So we'll be joined by John Strowger, who's a managing director at BDO, Ross McDonald, who's our head of debt advisory at BDO as well, and also Tom Green, who's an associate director at Aitchison Raffety. As usual, the discussions will be followed by a live Q&A, so please do submit any questions that you have through the Q&A functionality, which you should be seeing at the bottom of your screen. So we'll pick those up at the end as we sort of wash up the year-end process. But with that, I will hand over to Seamus, who will cover off the main elements of the Make UK Q4 report. Over to you, Seamus.
Thanks, Richard, and hello to everybody, and thanks for joining us. If a week is a long time in politics, then a fiscal quarter is certainly a lifetime. When Manufacturing Outlook was last published, and we last did this webinar, Prime Minister Liz Truss had just been sworn in by Her Majesty Queen Elizabeth II. The UK economy was growing, albeit just about, and the government opted for a mini budget of 45 billion in tax cuts. Spooked by that unfunded giveaway, financial markets' concern about the country's ability to repay its debts triggered a tanking of the pound that pushed the UK's monthly borrowing costs to their second highest since records began, resulting in higher loan repayments for businesses and mortgage holders, and a collapse in the value of pension funds. The IMF warned that the government's experimental economics threatened global financial stability. Truss was ousted from office, the shortest-serving Prime Minister in UK history, and new King Charles II swore in her successor, Rishi Sunak, who moved swiftly in the autumn statement to introduce a new era of austerity as the Office for Budget Responsibility, the independent watchdog over the government's finances, warned that the UK is facing into its longest recession on record. So what does that mean in terms of this quarter's Manufacturing Outlook results? Well, if I can move to the next slide, you'll see the overview of the key takeaways from this quarter's research. So the first point to make here is that output performance has remained stationary compared to last quarter, but the orders gap has closed slightly. UK orders and export orders have both turned negative, although export orders have turned slightly more negative compared to last quarter. Price levels, input prices remain at all-time series highs, and profit margins have declined yet further. But employment growth has been marginally positive, and there is clear intentions among firms to recruit even more in the future. However, on the investment side, investment intentions have turned negative for the first time in 7 quarters. As a result of all of this, our manufacturing sector forecast for the year has been revised down, and also for next year as well has been revised down. Our overall UK GDP forecast for this year remains steady, but we have revised it down for next year as well. So going into some details on the next slide, you'll see the output gap closing, but performance has remained stationary. So 2 years on since the start of the pandemic, manufacturers have been on a hell of a roller coaster. In 2020, the pandemic brought on the single largest quarterly decline in output on record, after which the economy saw a remarkable rebound in activity throughout the majority of 2021. This year offered a list of old and new challenges. Legacy effects from the lockdowns continued, but added into the mix came inflation and rising energy costs and other input costs as well. However, due to strong demand, output levels have remained positive over the course of the year, though they have slowed consistently quarter on quarter between Q1 and Q3. This quarter's Make UK Manufacturing Outlook survey, in partnership with BDO, shows the output balance at a positive plus 5%, unchanged from the previous quarter. It's the first time this year that the rate of growth in output has not slowed down in our quarterly report. However, the current expectations laid out by manufacturers in the survey suggest that industry is merely taking a brief cyclical Christmas boost break before the slowdowns continue next year, with expectations that growth will turn negative in 2023. Next quarter, manufacturers forecast an output balance of minus 1%, and the bleak forecast may reflect the current fiscal environment, particularly regarding energy prices. As we know, the government has announced that the Energy Bill Relief Scheme, the EDRS, will not be extended beyond March next year, except for as yet undefined vulnerable businesses. If gas prices remain high, it'll be difficult for many manufacturers to continue their normal business operations in the winter and early part of next year. The situation for intermediate subsectors remains mixed. So basic metals, mechanical equipment, and electrical equipment subsectors all reported positive balances for output growth this quarter. Rubber and plastics reported a flat performance, unchanged from the previous quarter. On the other hand, metal products, that is fabricators, and electronics reported negative output balances. The electronics subsector in particular continues to face supply chain difficulties in accessing key components, especially semiconductors. Manufacturers in the subsector expect an improved situation at the start of 2023, though recent US and UK sanctions on China might alter that possibility. Manufacturers in the middle range, that's the 10 to 24 million pound turnover bracket, have reported a very negative output balance this quarter. In many cases, these businesses do not have the level of collateral available that big manufacturers have, and are therefore likely to find it more difficult to weather the storm. So they're a key bracket that we need to keep an eye on, because they sit typically in the middle of supply chains and are therefore well integrated with both smaller and larger firms. So on the next slide, you'll see that domestic and export orders are both declining. So the total order balance remains positive this quarter, although the rate of growth has reduced by more than half. The gap between the balance for output and orders have narrowed significantly since last quarter, indicating supply chain disruptions may be lessening. Access to raw materials and inputs have been a challenge for manufacturers for several years now, but recently logistics costs have been coming down, which is a really good positive, reducing pressures on businesses. Container costs are now returned to their pre-pandemic price, thanks in part to a 40% decline in export demand from US businesses for Chinese-made goods following the Biden administration's recent imposition of trade sanctions there. However, the biggest reason the output and order gap narrowed is not the easing of supply chain disruption, but rather the fall in demand, which has resulted in a decline in new orders for many manufacturers. This quarter's data indicates that across our survey sample, manufacturers that sell both domestically and internationally appear to be performing better than those that sell exclusively to the domestic or export markets alone. We saw a significant withdrawal of smaller and medium-sized manufacturers from the export market following Brexit, with many companies calculating that the increased costs of exporting overseas were not worth the marginal potential benefits. The impact of this was masked in recent years by increased domestic demand as supply chains moved to reshore and onshore post-Brexit and during the pandemic boom in particular. But now those manufacturers that do not have diversified sales strategies are reporting declining UK orders as well as export orders. The interpretation of this data from our survey sample is supported by other proxy measures, most notably that businesses in the middle turnover region, that key 10 to 24 million pound bracket, those firms that typically lie in the middle of supply chains and therefore trade exclusively either domestically or internationally, are seeing larger falls in demand than larger firms further up the value chain. Till now, the domestic market's rate of growth has been a boon for the industry because even with rampant inflation, strong demand for goods from UK customers has kept business going in trying times. Manufacturers now predict negative growth for all measures of orders, both domestic and export, next quarter, indicating that output will fall at the start of 2023. So moving on to the next slide, you'll see the impact that this is having on firms' ability to plan for the foreseeable. So the tax burden is now at its highest since World War II. Prices are rising at their fastest rate for 41 years, driven by the cost of fossil fuels in particular. Inflation, which measures how the cost of living changes over time, is expected to peak at around 11.3% by the year end, remaining above 9% in early 2023, 4.5 times the Bank of England's 2% target, despite the Monetary Policy Committee raising rates 8 times in a row so far to try to get it back on target. For factories, producer input prices are even higher, up 19.2% in the year, nearly double the consumer inflation rate. Manufacturers are seeing a sharp fall in industry activity as a result of all this. So as I mentioned a couple of times already, semiconductor supplies continue to be disrupted by ongoing COVID-19 lockdowns, causing erratic levels of production in the Far East, a problem likely to worsen because of the trade sanctions recently imposed on that key market and key production centre of China. It is expected that UK interest rates will grow from their current level of 3% to 4.75% by next April, but they won't hit the 5.25% that markets had previously predicted. We're expecting the bank to make an announcement on Thursday, likely to be a further increase in rates. That's certainly likely off the back of news yesterday that the economy shrank in the UK by 0.3% this quarter, and the Chancellor announced that he expects the economy will likely get worse before it gets better. So the seemingly never-ending maelstrom of challenges continue to make it extremely difficult for firms to predict business activity even just 3 months in advance, and consequently manufacturers are consistently unable to plan ahead. The gap between predicted and actual business performance continues to be quite wide by our survey's historical standards, and that is not a good thing when you're working in an industry that typically takes decisions on investments that work in sort of 5 or 10 year cycles. Not being able to predict with any degree of real reliable foresight is a real challenge and a real problem. So moving on to the next slide, prices remain high, but profit margins have declined further. So as we move towards the conclusion of the year, this quarter marks the 8th consecutive quarter where Manufacturing Outlook's price metrics have soared. We've seen consistently high quarter-to-quarter price increases in every period since the start of 2021. Profit margins have also been in decline now for 6 quarters in a row. The sustained inflationary environment that UK manufacturers are operating in presents perhaps the most significant risk to firms next year. Many of the previous inflationary quarters up until this point have been at least accompanied by a strong demand outlook, as illustrated in our orders metrics. This, for the most part, has cloaked the worst of the damaging effects of persistent price inflation within the industry, as high demand has kept order books full, shop floors busy, and cash flows above water. Now, however, as demand cools significantly, the manufacturing industry is still saddled with significant price pressures that unhelpfully have not subsided in line with the fall in demand. It has been the expectation for some time that UK manufacturing was headed for a period of stagflation, a phenomenon where there is little to no growth, but where price inflation perseveres. And this is the first quarter where our data regrettably confirms clearly those predictions have come true. Our data shows that despite 8 consecutive quarters of price rises, the manufacturing industry has endured 6 consecutive quarters of profit margins decline, with the data this quarter indicating that the situation is worsening, with yet further declines both in UK profit margins and export profit margins figures at minus 33% and minus 25% respectively this quarter. It has become nigh impossible for firms to pass on their increased costs via higher consumer prices because new orders have begun to fall. One solace, however, taking the positive, and indeed however small it may be, is that the balance figures for our UK prices and export prices metrics are not quite as high as they have been in previous quarters. So new ONS data details a similar story, that the latest producer price inflation, PPI, figure stands at around 19.2%, or it did rather in October, a little down from the high of approximately 24% observed earlier on in the year in July. So that's a sign that things might be getting back to a little bit closer to what we might consider normal. The value of sterling has also stabilized after recent turbulence, which will improve on manufacturers' ability to set contracts with international suppliers and customers, and therefore to plan more consistently for the coming year ahead. And that's happened at a nice time too, coming at the end of the year. On to our next slide. Business and UK economic confidence have both fallen sharply this quarter. Average confidence in the UK economy has declined for the fifth quarter in a row, resulting in confidence in the overall economic environment falling into negative territory for the first time since late 2020. Many analysts are already expecting a recession, which some are suggesting that downturn has already begun. And that has particularly, that speculation has picked up following the news yesterday of the shrinkage this quarter. The East Midlands and Wales are the areas which are the most pessimistic across the UK. The Northwest reported the highest business confidence relative to other regions and nations. However, almost all manufacturers now expect a deterioration in the UK economy over the next 12 months. If we are to take one positive, it is that firm level confidence remains relatively positive, albeit also trending downwards. Though pessimistic about the overall economy, individual companies remain confident in themselves. That's despite manufacturers consistently underestimating their order books and overestimating their output ability this year. Such seeming confidence may reflect the normalization of previously unpredictable disruptions, or what economists call Knightian uncertainty, being built into business models over time. Since the pandemic, manufacturers have become significantly more resilient in the face of uncertainty, as practices to preserve short-term liquidity or just-in-case scenarios have become more prevalent. This may nevertheless lead to a long-term decline in investment activity, which is a sign that we appear to be seeing in this quarter's survey results. So while it's a positive that firms appear to be becoming more resilient, the long-term implication of short-termism in terms of the turbulence that they're facing means that they're not likely to make bigger investment decisions, but they're likely to put them off for further durations, and as a result not make them in the end at all. So confidence is increasingly a less reliable measure of performance due to the volatile economic environment that has become the new normal in effect over recent years. And therefore it's becoming increasingly difficult for businesses to plan effectively and to make proper investment decisions. In addition to this, the energy crisis remains the biggest threat to manufacturers in the short term, whilst labour and skills shortage will slow down the industry's recovery once these turbulent aspects do eventually come to an end. So it's a really challenging environment to be facing. Onto the next slide, we'll see that investment intentions have turned negative as a result of all of this. So both the employment and investment intentions metrics this quarter have trended downwards. In the case of employment, the past year has been characterized by a high demand amongst manufacturers for workers, both skilled and unskilled, but with insufficient supply to satisfy company needs. The difficulty filling roles is illustrated by our future 3-month intention employment metric, which has consistently shown over the year that manufacturers intend to hire more employees, but when that quarter comes to pass, companies were unable to realize an expansion in their headcount. The tightest jobs market for half a century has seen the unemployment rate drop to just 3.6%, and still there are 86,000 unfilled vacancies in the UK manufacturing sector. One positive that seems to be emerging from ONS data released just this morning is that there seems to be an uptick in the number of older workers returning to work. There had been a vast increase in early retirement, particularly for people over the age of 50 during the pandemic. But it seems now that many of those workers are looking to return to work, and they're often people that filled key skilled roles in the manufacturing sector. So that's a positive sign. However, it's still a very challenging environment for the labour market. We've seen 500,000, almost 500,000 strike days in total across the UK in the month of October alone, which was the highest since the peak of the global financial crisis and the strikes that were seen there in 2011. So it's been a very disrupted year for many firms as well. The main reason for the suppressed employment growth figures over the past year has been the shortage of supply in the labour market. However, with overall demand in the industry's goods cooling off now, the other thing we need to bear in mind is that the demand for labour will likely follow suit. And we are likely to see an increase in the employment figures probably around Q2 of next year. Elsewhere, investment intentions have entered negative territory for the first time since the first quarter of 2021, when the economy was in the grips of the COVID-19 pandemic. This quarter's results showing declining investment intentions confirm that the post-pandemic catch-up boom recovery period is well and truly over, as the new pressures of inflation, supply issues, and the energy crisis have become the primary challenges for manufacturing businesses. The sustained inflationary environment, has eroded confidence in the UK manufacturing sector's outlook, and much of the industry is braced for a very challenging year ahead. Many firms report that they are now looking to repurpose what was once capital expenditure funds or set aside for investment decisions into business continuity and contingency spending for next year to help them ride through the coming difficulties. So on to our next slide. You'll see that as a result of all of this, we have revised down our manufacturing sector output growth prediction for 2022 to minus 4.5% for the year. And next year, we expect negative growth of minus 3.2% in 2023. The services sector, which dominates the UK economy, is less impacted by the war in Ukraine, the energy cost crisis, and post-pandemic lag effects of lockdowns and supply chain challenges, etc. So overall, UK GDP growth forecast remains at 4.4% for the year of 2022. But we have revised our forecast down for next year to almost 1% lower, so 0.9% for 2023. So finally, just to review on the last slide, you'll see the key headlines that I've just run you through. So the output performance has been stationary compared to last quarter, and the order gap has closed. UK and export orders have both turned negative, though export orders have declined slightly more so. Price or the costs of inputs remain at all-time highs, and profit margins have declined yet further. Employment did grow and intentions are clearly positive, though there are a lot of reasons why we might think that might not be borne out over the coming quarter. Investment intentions have turned negative for the first time in quite a while. And off the back of that, we have revised down our sector forecasts for this year and for next year, and for the UK economy as a whole for next year as well. So that's all from me, and I'll hand you over to our panel. Thank you.
Thanks, Seamus. And exhale. I mean, looking at that, there's not a huge amount of good news that we're seeing, but it is consistent with what we're seeing in the market at the moment and the clients that we're talking to as well. So I think one thing that people have been talking about a lot over the last few months clearly has been basically two elements. One is inflationary pressures, and in particular energy prices associated with that, and what can businesses do to mitigate or to think through and plan around some of these areas. So our panel today, we will be discussing energy prices as well as business rates and interest rates as well. And we have our panelists who will be sharing their insights as well as some practical tips to think about as well. So we have joining us John Strowger. He's a managing director at BDO. He specialises in creating commercial and pragmatic solutions for organisations, lenders and other key stakeholders to protect or realise value. And that's particularly in stressed and distressed situations. We also have Tom Green joining us. Tom's an associate director within the business rates team at Aitchison Raffety, based out of Birmingham. Tom has over 12 years experience in providing rating advice to businesses across all sectors, geographies and UK jurisdictions. And then we also have Ross McDonald, and he's the head of debt advisory at BDO, which is one of the leading debt advisory businesses focused on the UK mid-market. And his team advise on a wide variety of areas, including private equity owned businesses, private and listed companies on debt capital markets. So welcome all three of you. Just to kick things off, I'll come to you first, John. Obviously, energy prices is a big element in terms of the challenges associated with the manufacturing industry at the moment. In terms of the current outlook for UK energy prices, what does that look like over the next 12 to 18 months?
Thank you, Richard. Good afternoon, everybody. Well, that's a very good question. So real crystal ball time, I think. Though cutting through, I think it's probably two major drivers around what businesses are going to be paying for their energy over that time horizon. The first is what's happening with wholesale prices, and the second, which is what does government do in terms of intervention and subsidy. So coming to the first one of those, the wholesale prices, I think the general consensus is they're going to stay high. Well, they are high, and they're going to stay high for at least the next 12 to 18 months. And important for me is within that, there's going to be a certain amount of volatility in there as well. So if we look back to what happened through 2022, we've seen real spiking of the gas price over summer, which has also led to connectivity between the gas price and power prices through gas-powered fired power stations. A spiking in that price because of the Russian invasion in Ukraine and the turning down and now turning off of Russian supplies, gas supplies into continental Europe. That led to a scramble on the continent to fill reserves ahead of the winter, and we're now into the depths of winter. It's certainly snowy out my window at the moment. We're expecting those reserves to run down across the winter period, and so looking ahead, it will be summer 23 into winter 23-24, where continental Europe starts trying to scramble to refill those reserves. This time round, potentially with no gas coming across from Russia, therefore putting much more inflationary pressure on shipments of LNG from elsewhere in the world, and that then becomes a global scramble for gas with inflationary pressures on price. Then the second is, what's the government going to do? As Seamus alluded to, there's the energy bill relief scheme. We're hoping to get a little bit of guidance from government at the end of this month as to who's in and who's out from the 1st of April. I think it's fairly fair to say from the trailing that there'll be businesses on this call who will unfortunately fall outside the remit as it gets scaled back down. We think considerably because of the burden on Treasury. Therefore, from the next few months are going to be quite crucial to businesses to put the impetus on themselves to work out what their options might be for mitigating potential spiking in their prices come 1st of April next year.
Right. Okay. So hold on to your hats. I think it seems like the message, John. It's going to be an interesting ride. I think you're absolutely right. That point of who's in and who's out and getting some clarity on that is going to be absolutely crucial. Just building on that, John, are there any particular practical actions that you'd sort of recommend to manufacturers in terms of mitigating or protecting themselves from any of those expected price rises?
Again, I'd love to say I've got a silver bullet that I can be handing across here, but I think that absent that, there are certainly things that can be done. I will lean on Tom in a moment for his input in a moment. So the first thing though is all about look, it's a tired old saying now, but it's true. Cash is king. So what are the options to actually get some money in from your energy supplier? So what we're seeing is consultants are in the market now, undertaking quite reasonable price reviews of energy usage, pouring through energy data and usage, comparing it to the tariffs, and comparing that to how much manufacturers and other businesses have been paying, and looking for opportunities where perhaps tariffs have been mispriced, hidden commissions, errors in the bill calculation, allowing often in some cases quite material retrospective rebate claims to be lodged with suppliers, which can be a source of cash up front. Otherwise, we're erring more towards the demand management side and reducing on-grid demand. Again, looking at the consultancies out there, and for relatively low price, a consultant can give a review of the portfolio, a review of premises, and understand exactly how energy is being used across the portfolio. And by that I mean on a half-hourly basis, working out what gas and power is being used on say the shop floor. Often businesses, these are all simple things. The business saying, well, we know we're turning the air conditioning off at night. We know we are turning the lights off at night. When those audits are done, what's actually happening on the shop floor can sometimes differ from what's being reported up the line. Those reviews can also identify opportunities to load shift, so running certain processes at certain times of the day, benefiting if you're on the right tariffs from lower unit prices, can also afford quite significant savings. Moving more towards a proactive work with slightly more investment, and accepting that readiness and the availability of capex is constrained at the moment. But there are options around investing in simple things like LED lighting or sensors that can only turn lighting and heating on as parts of buildings are used. That can again generate quite reasonable savings. And there are funds out there that are popping up that will actually fund that upfront cost of investing in these types of energy saving actions, with the payback being lower than the offset that's achieved. Then there's the more serious bits about on-site generation. So we're seeing solar, we're seeing wind, seeing biomass being installed on company sites. Again, there are examples of where third parties are coming in, actually constructing those assets on site, and then supplying that energy into the manufacturing facility. I will just pause there because a big part of investment payback appraisals is all around the ratings piece. So Tom, I think are there any incentives within, say, the business rates remit that might encourage or support any sorts of investments, particularly around the renewables?
Yeah, thanks, John. And I say good afternoon to everyone. I think it's a really good point, because for quite some time, the business rate system was actually seen as a hindrance to green investment, in that it was punitive. So that any time you invested in any kind of green tech, whether that's rooftop solar or biomass, as you were alluding to, it actually increased your overall value. So effectively increased your outlay. But from April this year, so April 2022, the government announced that any properties with these installations would actually have them removed from the valuation of the assessment, and this will continue for people who invest in green tech for use on site. And this investment of the P&M, the plant and machinery that's installed on those assessments, will actually be exempt from charge up until the 31st of March 2035. I mean, after such time, they will become chargeable. But I think the message there is that within the business rate system, if there is investment to be had, now would be the time to do that.
Yeah, thank you, Tom. I know we're going to be coming back to you with more insights in shortly. But as a closing piece from me, I suppose, is that don't neglect the traditional routes as well, which is having conversations with your TPI, with your broker, who'll be able to give you a good view of where the market is going, what the appetite is among suppliers for entering into contracts with your businesses, and the sorts of dowries they may be insisting upon up front, and what the options are to offset that. But also maybe also investigate some slightly more novel things like corporate power purchase agreements, where you're contracting direct with a generator because they're private. You're able to negotiate some flexibility in the rates that are being achieved there. But more broadly, we're getting to the end of the month. Potentially, we've got 3 months left on life support from the government, potentially. So it's important that businesses are also coming up with sort of the plan B, the plan C, because what we don't want to be doing is getting to the end of March and not having a fallback. So I would be very strongly suggesting that manufacturers are focusing on what those contingency plans might look like, have them ready in the drawer. Anything from something along the lines of mothballing parts of buildings or parts of the operation, through to potentially more drastic actions. But always best to have these thoughts now and up front, with a little bit of time ahead of you, than leaving it a few more months and really being on the back foot and running around.
Thanks, John. I mean, all good salient advice, right? Like you say, there's no silver bullet, but having a plan and really understanding what your demand profile looks like as well can be quite critical. The question is, what other implications does it have if you start thinking about reprofiling your energy demand throughout the day? What does that mean for the broader business? So there's quite a number of factors to think about around that, but considering energy for a number of manufacturers is a very large percentage of overall cost, thinking slightly more creatively and at least having a plan, like you say, is going to be really, really important. Tom, just coming back to you, I read somewhere that, in terms of rates increases, etc., anyone who's kind of using either light or heavy industrial properties, their average fees have increased by around 27% of their overall value. So it's a massive uptick. It'd be useful to get your views on, what sort of supports government has put in place for businesses that are increasing those increases in rates. And, is there anything else that businesses should be thinking about to be able to sort of mitigate that quite considerable uptick in terms of fees?
Okay, so a couple of points there. So in terms of the increase, I think it's important to frame it around why that is happening. So that business rates are valued in cycles. The current cycle we're in at the moment is we determined the 2017 cycle, which started 1st of April 17 and is due to come an end in the 31st of March 2023. So what we're going to see as of the 1st of April 2023, when the new cycle commences, is those increases happening. And there are reasons why these increases are happening, is that we, as valuers of commercial premises for business rates, value premises vacant and to let. So when we're looking at either light industrial units or heavy industrial units, the demand for those is increased significantly between the last cycle and now. So we're seeing quite an uptick in rental values, which obviously feeds into the rateable value. Okay, but in terms of what support the government has been putting into place. Now, what they announced at the autumn statement is that the continuation of transitional relief. Now, to put that in simple terms, is that it means that the increase between one cycle to the next is capped, so that there won't be some increases beyond a certain percentage that you'll experience. So in terms of your actual output, we talked about an average of 27%. I think one of the highest I've seen is around 65%. So there's this quite a significant increase there that could be experienced overnight, effectively from the 31st of March 23, and then from the 1st of April, you're paying on the new values, which could be considerably higher. And I think one of the other supports that is quite important is that for any of those businesses or any of those companies on the call who are actually experiencing a reduction in their rateable value, I admit that there won't be many, but there will be a few. In the past, those reductions were subsidizing the transitional relief for those businesses that rates were increasing. So effectively, instead of receiving the full benefit from day one, that you were paying a surcharge during the period of the cycle before you were actually receiving that full benefit. Now, the government have actually decided to fund that themselves and have removed that provision. So if you're lucky enough that your rateable value has gone down, you will actually receive the benefit from day one, which is a positive. I think your third question was, what can businesses do to mitigate their rating liability? And I think the first point there would be to actually understand how that rateable value is determined. So when we're looking, we talk currently about the current cycle, because we've still a few months to run on that, is that is based on what your premises would have let for were it available on the open market on the 1st of April 2015. And if you can actually employ someone or look at those values, the opportunity to reduce that overall value still exists. So we still have a period of time, albeit limited, up to the end of the current cycle. And if you can demonstrate that the value of your premises is too high, that reduction will be backdated to the 1st of April 2017. So we're talking a 6-year block potentially there of cash savings. And I know I speak to many businesses who've effectively just paid the rates as they were given and accepted them. And as another point to maybe touch on is the fact that the business rates are based on your floor areas. So if you haven't had your building measured or surveyed at any point during that last cycle, and you've had parts of your premises removed perhaps, there may be an opportunity just on a factual basis to have your overall level of value reduced. So it's certainly worth employing someone to have a look at that and analyse as to whether those values are correct. As I say, because that time frame to do anything around about the 2017 cycle is fast reducing.
Thanks, Tom. So obviously there's going to be a new rates revaluation as of April 23, right? Mm-hmm. So anyone who's in, I guess, everywhere apart from Northern Ireland is going to receive that new rateable value. What sort of changes, is there anything you can sort of fill us in on in terms of those key changes that will particularly impact manufacturers?
Sure. I mean, I think I touched on a couple of points there. I mean, effectively that, if I might touch on the reason for the large increases. Now, I touched on it in my last point that for the last cycle, we were valuing premises and what they would let for in April 2015. Now we're valuing premises and what they might let for in April 2021. So it's normally 2 years prior to the start of the cycle. Now, rental growth in that period for light industrial specifically, because of the growth of the Amazons, etc., buying up large warehouses to use for distribution centres, the rental growth has been vast. So that demand for that type of premises has increased. So unfortunately, those properties are the ones that are going to see the steepest increases, albeit mitigated by the transitional relief that we discussed earlier. I think the second sort of big change would be that we're going to have a move to a more abbreviated revaluation. So since the inception of the current regulations, this was back in 1990, the intention was to have a revaluation every 5 years. Now, the last two cycles have both been extended, so for 7 and 6 years on the past two cycles, respectively. However, the current cycle will be abbreviated to a 3-year cycle. Now, the reason they've done that is because they're trying to link business rates more directly to the economic conditions at the time. So we're talking 6 and a 7-year revaluation. You're talking there between 9 and 8 years post valuation date that people are still paying their rates on, which is vastly out of date. And that's why we're seeing the big jumps between cycle to cycle. Now, the idea eventually would be to bring the valuations more in line with the economy by having revaluations on an annual basis. What that will look like in terms of how the valuation office can gather that data and how they can process it into something that's manageable, the jury's out on how quickly they can do that. But that is certainly the intention. And then I think the one sort of final point to update you on for the new cycle is that the valuation office or the government intend to introduce what they call a duty to notify. Now, many of you at the moment will receive what we call FORs, or forms of return. You get those on an annual basis, and then you're asked to fill out certain elements of your rental information, whether that's the term, the actual overall rent that you pay, whether there are any incentives in there. And the rest of the information gathering has been down to the valuation office to do, so they send out people to reference or measure buildings. But again, their resources are so stretched that those resources haven't happened, and those surveys just haven't taken place, not with any frequency anyway, and certainly not with the frequency that the government would like. So with this duty to notify, they are moving that burden of responsibility from themselves via the valuation office to the ratepayer. So what that will look like will mean that you will have to, as a ratepayer or via your agent, whomever you employ to do this, will have to undertake an annual duty to notify via the government gateway. And in there, you'll have to put in all of the details about your premises, whether that's you've installed a new mezzanine floor, you've converted office accommodation, you've built an extension, you've demolished areas, you've changed the use, anything like that. The burden will move to yourself as the ratepayer to inform the valuation office of those changes. And again, it's not limited to the physical conditions of the building. The move is also to actually include any elements of your lease that happen. So anytime you have a rent review or a re-gear or any change in your tenancy agreement with the landlord, it will be up to you to inform the valuation office of all of those changes. So, I mean, there are some sort of fairly obvious pitfalls there in terms of those of you that have built mezzanine floors, for example, within your accommodation that aren't currently in your assessment. Once the duty to notify is established and is in, those areas will become rateable and chargeable. So it's important, I think, to be mindful that your buildings will need to be measured properly and correctly to ensure. Again, I made the point earlier that your rates will be valued on floor area. So if you get if any of those floor areas are incorrect, whether that's in your favour as has been in the past or not so, it's really important to employ the right people to get that professionally measured, so that your rates are valued certainly on what actually exists presently.
So thanks, Tom. So it's time to get the tape measure out, effectively.
Yes.
Possibly a very large tape measure for manufacturing sites. Thanks very much, Tom. That's really helpful information as well. Just moving across to you, Ross. Just in terms of, interest rates are going up, inflation's going up, and all the rest of it. I mean, it'd be really good to get a view from you in terms of how you're seeing lenders behaving towards sort of new credits, now that we're kind of in a very different environment than we were a year ago, with really sort of, far higher interest rates that we're starting to see.
Understood, Richard. Thank you, and good afternoon, everyone. Look, I guess starting off on a positive note, to try to counteract so far, prospective borrowers have never had as many options as they've got today from a vast pool, a broad range of different types of lenders. So, whenever we chat around sort of the last, I guess, market cycle, I suppose, back at sort of GFC time, then there was a real challenge around finding anyone that would lend, and there was an over-reliance on the banks. Whereas now, the options that we've got are much broader in terms of ABL alternatives, so asset-based lenders, lots of not just pure play banks, from US banks, from sort of specialist lenders, coming through to direct lending funds who specialize in different areas and can price risk. So there's a vast sort of swathe of different options available to lenders. But in terms of today and how we've seen lenders react over the last few months, I suppose, the concerns are clear. In a recessionary environment, there's concerns from lenders around the impact on demand. There's cost price inflation and the impact that has on businesses. And then there's clearly the cost of debt, which is going up as interest rates, I think 3%, and markets are expecting them to be up at 3.5% potentially on Thursday. So all of these are going to be impacting on any lender's mind. And what does that mean? What we've seen from lenders in terms of behaviors, there's increased polarization in lender appetite. So those lenders, there's sort of a flight to safety in a way, whereby lenders are moving away, and it is undoubtedly a lot harder for those lenders that are perceived to have increased exposure to the cycle. At the same time, we're seeing lenders a lot more focused on downside sensitivities. So lenders are much more cognizant now of what will this business look like in the future in terms of its exposure to cost base increases, labor increases, and so on. So there's a lot more onus then on the borrowers presenting different sensitivities. And the other thing, which certainly very much impacts on those businesses that are trying to sort of push the envelope whenever it comes to leverage, is around cash cover. In yesteryear, in the sort of wonderfully benign conditions that we had post GFC, cash cover became much less relevant, and lenders were much more focused on leverage, to be honest. And now there's much more focus on cash cover, just on the base, for the very reason that the cost of debt has gone up. So it is harder to service that debt. So we find that that's constraining lender appetite, and undoubtedly then leverage levels have come down a little bit. I think those are the three key things that I would take away. I think in terms of if you're a prospective borrower, and I'm going to jump to the next question, the onus is then on the borrower to really sell the credit story to prospective lenders. With this increased polarization and appetite, you want to be making life easier for that lender and taking the time and investing in understanding the credit, understanding how you sell that credit, and understanding how you present all the mitigants. If you can position yourself as one of those credits that is robust enough to withstand the cycle, and that you understand your exposures and you've mitigated that risk, it makes life a lot easier for the lending community and for you to gain traction. And we are seeing that reduced liquidity in the market. There are definitely, it's less competitive than it once was whenever we are trying to sort of drive terms and leverage competitive tension. The other thing that's worth being aware of then as a borrower is actually really understanding the lender pool. I talked at the beginning there around the number of options that are available. Actually having an understanding as to who's there and who's likely to have an appetite for my credit and who's able to offer the flexibility, potentially of price the risk that will enable me to deliver my funding objectives. So I'd say those are two really important areas for any prospective borrower to be thinking about if they're considering going to market.
Thanks, Ross. It's basically do your homework, isn't it? It's make sure you understand the lender community and really plan properly so that you are best positioned to de-risk any of those conversations. Thanks for that. Really helpful, Ross. I think if we sort of, conscious of time, we'll sort of draw the this panel to a close. But thank you to all three of you, all really useful insights in very different areas, but all relevant for manufacturers. I think we've probably got a couple of minutes to pick up any questions that may have come through. So, Bal, if I can hand over to you, if you could do the honours for us, that would be great.
Yeah, no, brilliant. So we've had one question come through, and Seamus, if we start with you, and obviously if the other panelists have any thoughts on supply chains, please do share your comments as well. So has the supply chain volatility experienced during the pandemic now resolved itself to a more business as usual state? Do you have any thoughts on that based on what you're hearing from your members?
That really depends. It's an excellent question. It really depends on the sector or the subsector in question. So electronics, as an example, is one that is heavily reliant on semiconductors, as is automotive. There are, in some cases, up to 5,000 semiconductors per car in some of the more higher end vehicles that are produced. And the majority of the world's supply of semiconductors comes from China, which obviously has continued, albeit it's now beginning only this week or so to end its lockdown and its COVID zero strategy or zero COVID strategy. But it has continued to initiate lockdowns in key trade ports, Shanghai in particular, also industrial zones throughout the country, and that has had a knock-on effect for the production and the sale of semiconductors across the globe. But the other side of it has also been that because trade hasn't been coming out of China, there have been knock-on effects in terms of just freight capacity, because so many container ships were stuck in ports in the likes of Shanghai, and therefore there were delays throughout the global supply chain for other products as well. So we have seen significant disruption persist for the subsectors most affected by those issues. That said, industries like rubber and plastics, basic metals to a lesser extent, with the sole exception of some key metals that are produced in Russia, mechanical equipment, a lot of other sectors seem to be getting back to what we would call close to normal, albeit there are still some disruptions here and there. But I think we are getting back to something more like normality. The other aspect of this, of course, is the impact of the energy crisis. So a lot of firms, particularly smaller firms, have found paying for energy, not just in the UK, but in other countries as well, has become so costly that they have decided to shut down or reduce their output over periods, and that itself has had a knock-on effect on the supply chain too. So while we have improved and we're in a much better position than we were, say, at the peak of the pandemic, there are still some issues percolating through the system, but we are hopefully heading back towards a more settled state in the coming months.
Thank you, Seamus. Any comments from the other panelists on that at all?
I was just going to say that we're seeing exactly what Seamus has been picking up on. The other thing that we've also had conversations with the clients about is the relative cost of energy between the UK and Europe, and the level of support that governments are providing, and the clarity they're providing and certainty they're providing around energy costs in mainland Europe versus the UK. And that's an area that is a level of concern for us, just in terms of longer term competitive ability for US manufacturers versus their European counterparts. So I think there's a few things to think about here. I think that there's probably some understanding what that government support will look like in the next month or so is going to be absolutely crucial to that, and also the timeline around which they will place that certainty, because I think that allows businesses to at least plan effectively for whatever outcome that might be.
Brilliant. Thank you, Seamus and Rich.
Yeah, look, from a debt perspective, our challenge in advising prospective borrowers is, how do we prove out what's the demonstrably sustainable underlying EBITDA that lenders are prepared to structure off? And all of this, moving from COVID uncertainty to inflationary uncertainty, it's again, I guess, re-emphasizing the message before, the level of doing that prep work to understand and presenting what we believe to be a normalized number, and presenting the data that proves out what that looks like, becomes all the more important for lenders to then get comfortable that they can structure. So it's unhelpful for lenders, and it certainly again goes back to preparation.